Peter Mcguire joins in now to talk to us about what he's making of the global setup. Morning, Peter. Thanks for coming by. Peter, what is your sense? Most global markets are shut, I know, but we've had some data coming out of Japan this morning. Pretty pitch in your mind?
Well, good morning, and thanks for inviting me on the show. Look, I feel as though from where Japan sits, I'm expecting 2017 to be a fairly good year for them. Overall, the Nikkei's had a lovely run-up over the last couple of years, and Abe at the wheel certainly is trying to do whatever's possible to engage the country and to get economic growth, and that seems to be the major concern at the moment, and I think that he's the right man for the job.
Peter, of course, we've had things looking pretty good across the US, so those markets, as compared to any of these emerging markets, are doing relatively better. As we get into 2017, I'm not going to talk about the next few days because, that's pretty inconsequential given volumes are low. But what is trade going to look like in the first half of next year? Do you think Asian markets, emerging markets like India will play catch up?
I think they will. I think fundamentally you're going to see that continued growth across the US after the inauguration. It's been a lovely Trump rally for the best part of a month and a half now, and I feel as though that will continue. I'm not suggesting you're going to see a 21,000 handle for the Dow sometime soon, but I wouldn't be surprised to take it out by possibly the end of February. I think you're going to see continued uplift. The Dow's had a 19.5% growth year on year, which is just extraordinary. Crude's up over 100%, and gold had the best 6 months since 1979 for the first 6 months of 2016. So overall, I think any trader looking back is going to say US dollar stronger. That will probably continue, and very much the opportunity to really gather momentum for those emerging markets in the 2017 year. So I think it's going to be a very, very good year for traders.
Peter, the bigger question to ask is, especially in the US, we've seen the markets move one way up, really. So whether it's equities, whether it's bonds, or in fact, some of those commodities, including crude. And of course, the dollar now with the kind of Fed rate hike timeline that's at least been given for 2017. When was the last time that you saw almost all asset classes move in a singular direction, and that too in positive territory? And going forward, does this raise fears of some of these asset classes becoming overheated and maybe signaling to some kind of a crash coming in the future if something doesn't go according to plan?
First thing, it's been quite a number of years until you've seen all asset classes, including real estate, have such a dramatic uplift. Though that was the agenda coming out of GFC, that central banks naturally had to support growth and get economic, conditions back on track. And we've seen the Dow and the S&P and real estate prices really, do incredibly well over that, 7 to 8 year period. Where crude oil, I think that's going to have possibly a handbrake around that $60 to $65 handle. I can't see it going to be a lot higher than that for quite a number of years. So unless you see something dramatic happen from a geopolitical front or shortages or outages or something like that affecting markets. As far as US dollar, I think that will possibly continue with central bank strengthening of rates in a couple for 2017 for Yellen. And overall, to see some sort of flat line, I don't think Trump's going to allow that. I really think that he's going to be very centred with his approach, and he'll certainly spend quite considerably for the first, 18 months to 2 years to make sure that he actually gets some traction. So that's where I'm thinking. I think 17 is going to be a stronger year than 16, and 18 will be probably on the back of that fairly bullish.
Right. Peter, talking about markets like India, we've had our own headwinds, if you can call it that, demonetization, and now talk by the Prime Minister, and of course the FM coming out and reinstating that the PM was misrepresented. How are you playing India? So I'm not sure that you've read that commentary, but the PM slightly, in some words, indicated that there could be some sort of long-term capital taxation for equity market participants. The FM, of course, correcting that. But do you think we have our own problems and things are only getting tougher when you look at India as an investment destination?
Well, I look at the demonetisation and what happened there. I was in India in October, and then it came in towards the end of the month, early November. I was quite surprised, along with, I think, most investors and of course, the domestic, the population, how it plays forward from here. I give Modi a big tick. I think that you'll always have discussion points as far as was it the right strategy. I feel as though in some ways it probably was. And moving forward, there will have to be some form of taxation for equity traders and for other investment classes, because like any economy, you need to, take on board taxation and probably mirror image to a lot of the growth economies, and certainly what Europe plays, and of course America and likes and Australia. So going forward, some form of taxation, GST, widening tax bases, all of those sort of things, I think are just going to be the pathway forward, maybe not next year, but certainly over the coming years.
Is the point, isn't it, Peter? Because we've seen India vying for a ratings upgrade. Now, both Moody's and S&P recently have said that they'd like to see more reforms come in before they go ahead and give that upgrade to India, or revise India's ratings rather. But the point is the GST looks to be delayed. It will not meet its April 1 deadline. That's what we're picking up so far. When you have divergent commentary coming on something as crucial as taxing capital markets from the top two leaders in the country, and of course the demonetization pain that we're dealing with at the moment, what's the kind of signal that it sends out to the global investor community at large, to the rating agencies, with regards to how India is functioning at the moment and whether we deserve that rating upgrade or not?
Well, the introduction of any taxes, and it's normally you have a headline number, or when you a stick in the sand and say, right, we want to achieve it by such and such a date. To push it back is a normal course of events for most businesses, and it doesn't surprise us. The first stage, of course, was to take everyone offline, and which was the demonetisation. So cut circulation for 500,000 rupee notes, 500,000 rupees. So in turn, that creates its own complexities, but also it confuses a market as far as domestically, I think, for a lot of the consumers and the population, and it gives probably some longer-term, it can quite easily afford the government a longer-term introduction. And if it pushes it back 6 months, it pushes it back 8 months, I know that it's going to be around the corner and it's going to be introduced. And possibly it could have been too much of if you look at the other way, like a trader, a contrarian view, it was possibly too much information coming to a market so quickly. So in turn, just delay a factor and introduce the other side of it.
Peter, most Asian markets, I believe, have done about 9% returns for 2016. We, as compared to them, have done negative returns. Keeping this in mind, do you think it's a good time to start buying into India? Because, the fundamentals are intact. The macros still look pretty impressive.
Oh, yeah, and you look at what the IMF's, growth forecast, and strongest in the world, probably by 17 or 18. So, I think deservedly so, you're going to see probably a pretty good year for India as far as equities. They had a really good run up over the last few years. Certainly, the current 16 wasn't that great, but the years prior were certainly standouts, and I think that will come back. Markets go in valleys and peaks, and like anything, sometimes they just grow ahead of themselves and they run out of a bit of steam, and then, they gather momentum again and off they go. So you're going to see, I think, the fundamentals are there. There's no negativity, and I feel as though, the longer term, it's the place to be. And it's going to take some convincing to prove otherwise, because I truly and utterly believe in the numbers, and I think that you've got the right economic conditions for continued growth over, quite a number of decades.
Peter, very quickly, your view on crude. Surprisingly, the crude has been running up for the last 7 days ahead of that OPEC and non-OPEC cuts. Are you taking those seriously? What is the sort of level we are looking at in terms of crude prices?
Well, I was there in Vienna for OPEC on the 29th and 30th of November. I flew into the meeting. I was quite contented as far as and satisfied with the commentary coming out from the ministers. I think it really satisfied the marketplace as a whole. And then moving forward, that next weekend where the non-OPEC producers sat there and they tried to get headline numbers across where we see cuts and so on. Objectively, I feel as though it'll run out of steam. Anything above 60, you might get a fraction higher. You're also getting a free run in the sense where producers are getting paid in US dollars. That's been very, very nice for them with that growing US dollar strength. And overall, as more of the US rigs come onto line with higher oil prices, I feel as though that's going to be the handbrake moving forward. There's still an oversupply of crude. Kashagan's got to really start producing over the next year and a half, which is one of the largest fields. Those deep water fields in Brazil are going to do the same. So I think we're going to be awash with oil leading up to 2020. Further out than there, well, it's a bit too hard to speculate. But I feel as though you're going to be a $55 to $65 trade over the coming couple of months. You may see a bit higher, but I don't think you're going to see, anything breakouts from that.
Right. Peter, just before we let you go, in terms of 2017, what are the big fears? What is something that could dent market sentiment going forward? Could it be geopolitical issues? We have a couple of key elections lined up in developed economies. Could be something else that could really dent sentiment going forward?
Geopolitics are a big concern moving forward, and I feel as though you've got an inauguration only 3 weeks away for President-elect Trump. What happens there? Where does Putin play in all of these moving forward? What happens in the continuing saga and the tragedy of Syria? What happens as far as those mature markets and elections moving into the Holland or Dutch, of course, Germany, and what happens with the other outliers being France and so on? There's the first part of it. The second part, are we going to see continued growth coming out of emerging markets moving forward? Are any handbrakes coming into the market? I think fundamentally it's not a bad place to be. We're still off the end of that, really low rates, and I think that will continue for a few years yet. Geopolitics is hard to speculate on as far as the unknown unknowns. But fundamentally, I think that 17 is going to be a reasonably okay year globally for equity markets. So at the moment, I'm sitting there going, I see a little bit of blue sky.